And that's how I work with investors. The first thing I ask them is like, do you want to grow wealth, or do you want to just preserve your wealth? So those are two different avenues. And then liquidity is the first thing that comes to mind.
Hello, and thank you for joining us today on the Gentle Art of Crushing It show, where we focus on learning and sharing with our listeners all there is to know about how to create success in our lives. This show stands on the shoulders of giants. Our mission is to empower and inspire our listeners to create the life of their dreams whilst having a blast in the process. Let's celebrate life together. Welcome to the show.
All right. Welcome back to the Gentle Art of Crushing It podcast, Passive Investing Edition. My name's Randy Smith, and I'll be your host today. And I'm really excited to have Hicham Hajhamou with us today. Hicham and I are in a mastermind community, and he is one of the most well-educated passive investors, alternative investors that I've met to date, and really excited to be bringing him to the audience today. So by means of a background, he is an investor, he's a small business owner, he's a financial coach. He's actually one of the go-to guys in this passive investing micro tribe that I mentioned earlier. He's the managing partner of Wealth Flow Partners, and he's invested in 20 plus syndications, 15 different operators in all kinds of different things. So Hicham, welcome to the show. Excited to have you here.
Thanks, Randy. Happy to be here.
Awesome. Well, why don't we just jump right in? Can you tell the audience a little bit more about yourself and how you found yourself with us here today?
Sure. Yeah. So my background, I spent 25 years on Wall Street, mostly trading global macro, fixed income, inflation type of products, and obviously being on a seat every day, taking the pulse of the market and looking at all kinds of investment. And have a kind of a high W-2, but at the same time very very busy, very taxing on the stress, very taxing on your ability to find time outside of it to do other things. And then so I evolved over the last few years doing a little more of what we're passionate about, I think you and I, in passive investing and finding good deals. And then I started, as I started doing that over the last few years, I just had more and more friends and people coming to me and asking me, for either help or things that they hadn't thought about. And, I don't know how to do a due diligence, or what type of investment should I be making. I just got like a liquidity event. And so, that became a little bit, a passion in the last few years, and really trying to educate, share, and have them like just get a better sense of their financial setup.
Are you interested in real estate investing but don't know where to get started, or think you don't have the time or money? Are you stuck in your W-2 because the golden handcuffs make it hard to walk away? If this sounds like you, check out impactequity.net and schedule some time to talk with the founder, Randy Smith. Randy went from massive income to leaving his W-2 through passive income, and he can help you do the same. www.impactequity.net.
So that's intriguing to me too, because there you spent 25 years on Wall Street, essentially an expert in your field, and you made the decision to move into, and maybe not 100%, but at least a portion of your holdings into alternative investments. So what is it about the alternative investment space that intrigues somebody who spent so many years on Wall Street, or maybe kind of pulls you away, at least a portion away from that? I'm curious.
Yeah, I mean, there's this beautiful statistics that I looked at, and it says that the retail investor has only 5% alternative investment in their portfolio. And that was shocking to me, because obviously I've done all kinds of investment. I invest in private equity, in hedge funds, in all kinds of other alternative assets, including obviously real estate for the tax advantages that we know about. But that statistic was shocking, especially when you compare it to where pension funds or endowment funds, who are really savvy investors, Harvard and Notre Dame and a bunch of other like endowment funds, they have between 30 and 55% invested in alternative assets. And so, over time, you look at their at how well they've done compared to a retail investor who is is going to have most of his 401k or uh, pushed into the stock market, and usually timing it the most wrong way he can, in the sense that when the market crashes and that's when he needs to get in, he tends to get out. And so buy high, sell low, which doesn't really work. uh,
Sure, sure.
and so, just I felt like alternative assets are actually forcing people to stay invested more for the long term, right? Because a lot of
Okay.
these assets, they have to keep you in the investment for 5 to 10 years. Sometimes you have locks for as long as that, and sometimes for a retail investor, it's a good thing, right? Because instead of trying to play the market and timing everything and getting in and out and spending money in commissions,
Yeah,
you're there for the long run, and over time you compound a lot better than
interesting.
if you manage your own portfolio. And
So you would say, and it's interesting because a lot of retail investors will look at the illiquidity of alternative investments as a negative, but it sounds like you might agree with me that it's actually a positive and will help in the long run.
yeah, no, it definitely helps. And I think it's right to highlight that there is a liquidity premium for it, right? Because and that's how I work with investors. The first thing I ask them is like, do you want to grow wealth, or do you want to just keep preserve your wealth? So those
Yeah.
are two different avenues. And then liquidity is the first thing that comes to mind. Then we start building a portfolio that is going to have some you know money market and short-term instruments and debt funds, just to kind of manage the what I call the cash management, 0 to 12 to 18 months money
Yeah.
that you might need over the next 18 months. And then anything else that you can postpone for between 18 months, 5 years, 7 year, 10 year. um, and those assets, obviously. Then we look at the tax optimization of things as well, right? Like, so
Okay.
some assets are going to get you a lot more than just the return that you get on them, right? And so, as you know, you're investing in multifamily that tend to have a good amount of depreciation, sometimes 30 to 60% that comes out of your, passive income.
Mhm.
So all these, when you add them up, real estate is a good tool for wealth growth, because it's not only tend to give you better returns, but on top of it, getting some tax advantages from it.
Yeah, interesting. So, yeah, you talk about this idea. It's interesting that you ask if they're growth or wealth preservation. I usually go down growth versus cash flow, but I like that you're thinking about the wealth preservation piece. And really, in either one of those, you're looking at a cash flow component, it sounds like. Is it
Totally.
generally like, is it generally a percentage of the overall portfolio that you focus more on cash flow, or is it just more based on the needs of the individual?
I think it's a lot of the time it's going to be on the needs of the individual, in the
Okay.
sense that someone who tells me I'm trying to get out of my W-2, I'm going to quit tomorrow. I'm like, no, stop. Let's think it through. Let's get what you can have, because being in a W-2, from the bank's perspective, you're a stronger financial state, and therefore they'll be more willing to give you a line of credit, to give you stuff that will help you when you get out of the W-2.
Yeah.
So, and for someone who's going to quit his W-2, he's going to need to replace a lot of cash flow, right? Because that's one thing that W-2 does, is that at least there's security in getting, not always, but there's a lot of the time security in getting that cash flow on a monthly basis. And so
Yeah.
we try to work more on cash flow than capital and appreciation, to try to replace that cash flow. Is if a person is more very wealthy, and they don't really care that much about having cash flow, they still have a decent amount of cash in the bank. uh, then some appreciation plays, some tax advantages, some estate planning, then come more handy for these type of people. But I'd say that, like, when I look at deals, especially in real estate, I don't buy anything that is not going to cash flow year one. And you've seen a lot of these things, especially lately, where rates are higher, therefore your financing rates are going to be more taxing on the overall pro forma of your investment and syndication. you tend to see that, sometimes negative leverage, but also not a lot of cash flow at the beginning. And I just try to avoid these because I want to have cushion. I don't have a crystal ball, and so the only thing I can do is do more due diligence and make sure that the deals have enough cash flow for the stress scenario that I can inflict to that trade.
Okay. Well, and maybe if we could dig into that a little bit as well. I know due diligence is something that we talk about constantly. It's something in our tribe that seems to be the majority of the discussions that are occurring there. So I'm curious, what does your due diligence process look like when you're looking at a new operator? Or do you even look at new operators? Are you looking only at referred deals, or like what does that process look like for you?
Sure. Yeah, so I'm very big on diversification. I think one of the only laws of finance that help you over time is obviously the eighth wonder, which is compounding, but also
Yeah.
diversification. And so for me, diversification is I'm very open minded, and so I don't mind looking at smaller operators or people who are beginning if they have a background that shows me that they have a personality that can withstand you know cycles or stressful times in a right way, if they're communicating well, if they have a thought process around how they built their syndication.
Sure.
um, I won't mind putting some money, especially if it's always a risk reward, right? Like, so with
Yep.
those type of new operators, I have much more risk, so I will be requiring a lot higher return from them, right? So
Got it.
if a traditional, very strong operator who's been doing that for 20 years, has seen many, many exits, is offering me on average, let's say, maybe 14, 15% IR type of terms, with
Yep.
someone who's of a newbie, at least in the asset class, might not be a newbie, might have some investment acumen, but he's starting in this asset class, but he understands it well and he's worked on it for a while. I'm still going to ask for returns probably in more like the 20 to 30%, you know,
Okay.
to compensate for the risk that I'm taking with this new operator. And then
Well,
and then it's going to be again a smaller portion of my portfolio, right? Like, so if in a,
sure.
in a strong operator, I'm willing to put up to 5% of my portfolio on average. In someone like that, I'm not going to put more than maybe half 1% of my net worth in some new.
Got it.
But that doesn't mean that I won't add to it as the operator proves himself as he goes, and I return some of my money, and I feel comfortable with them over time. You know, I will slowly
Yeah.
add to them.
I think that's a really great point too. It's interesting how many small operators that I run into that are offering, 14% IRR with the same cash on cash returns that I see people with $2 billion in AUM that have been doing this for decades. And I will always ask the question, like, why would I place capital with you at a higher risk to get essentially the same exact returns that I'm already getting from somebody who's tried and true? And I think at times I offend people when I ask that question. But at the end of the day, ultimately, it does not make sense to me to be betting on a jockey that doesn't have many races under his belt, essentially, right?
100%. And and I see it also like in debt funds. So like debt funds, obviously, we can talk about macro later because that's one
Yeah,
of my baby thing that I like to do. Uh,
yeah,
but I see a lot of guys who are like, oh, I can get 10% for a first lien debt fund, and this guy's offering me 12%. Should I take the 12%? I'm like, so is it a first lien as well, or no? This one is second lien, and I'm like, well, 2% doesn't compensate me for being second lien, and after
yeah.
20 people in front of me, to get their money back before I do, and so it's a little bit the same situation, right? In one
Yeah.
where
And it's interesting. So we've not talked about debt funds hardly at all on this podcast to date. We've talked primarily about traditional syndications or fund models. Can you share with the audience what a debt fund is and what some of the benefits are of looking at debt funds for a portion of your capital?
Yeah, absolutely, and that's something that I use, a lot, especially for the cash management part of it that I
Yep.
mentioned before. You kind of build a ladder portfolio, right? So it's been, and nowadays you're getting compensated for it. So for many years, right, like in the last 10, 20 years, the rates were at zero for so long. You were getting nothing, pretty much zero on your bank account that you left your saving account at Chase or Bank or Bank of America. Um, but nowadays, like, just even a money market fund is going to pay you, about 5.25, 5.5%, right? And something that
Yeah.
you have daily liquidity. So why would I leave any money in my checking or my savings if a money market fund I can have, and if I need the money tomorrow, I can just sell this and get my money tomorrow. So
Yep.
again, I'm going to build a portfolio that for the liquidity that I have between now and 18 months, and it'll be between 5.5% in money market fund, and then I'll use other debt funds that are going to pay me more, between 8 and 14%, depending on which one it is. Um, and But obviously, I don't have daily liquidity for those. It's more like either a quarter, 6 month, or a year lock, meaning
Okay.
that I have to be willing to leave that money for a quarter, 6 month, or a year. Uh,
Yep.
which is not terrible for something that's going to pay me as much as a syndication now, like, uh,
Yeah.
and that's very valuable. And so those debt fund are going to be, there's all kinds out there. There's funds mostly, obviously, in real estate. So it could be people who are hard lenders and they give money to people who flip houses. Uh,
Yep.
and They'll be obviously first lien and have the collateral against the house that they just bought to flip, which should give you some comfort, depending on how high the loan value. I don't want to get into too many details, but could be
Sure.
debt funds that, for hard money lending. It could be debt funds for bridge financing for larger multifamily project or development project. And then I have, a lot of other, they're called the interval funds. And those are, you know, pretty institutional in the sense that they have, sometimes billions of dollars of AUM under them, and they're very, very diversified in all kinds of things. So it could be royalty deals, it could be finance litigation, it could be uh, asset-backed securities,
Okay.
financing. You have all these little things, and you're well diversified, and these, tend to pay 10 to 13%. So with a
Okay.
quarterly liquidity. So for something institutional like that, it helps like lather your portfolio, your short-term portfolio, and be efficient with your cash management.
Awesome. Very good. So yeah, thank you for walking through that. It's something that I've started to spend more time looking at. Something I'm going to start investing in more myself as well, and something I might bring to my investors in the future as well. So thanks for walking me through that. I think it's an interesting piece because as a high income W-2 guy, as I was, I had less concerns about the cash flow when I first started in this alternative space, um, and I thought I was just strictly a wealth investor at the time. But all of that changed and came to a screeching halt when I got laid off in June of last year, or April or May of last year. So can you talk about kind of the importance of having like a balanced portfolio for those folks that, as you mentioned, they might be wanting to leave the W-2, but it takes some time to get prepared with your investments to where you can actually step away and do that. So is there any specific type of strategies or paths that you see folks take as they're trying to exit their W-2?
No, it's more like just to prepare for, having the right legal structure, starting to think about tax optimization. Because like in your high W-2, a lot of the guys that I've seen, you know, they would just be so busy in their job, they didn't think about tax optimization. It's just like pay the taxes that they needed to pay, and usually a
Yeah.
lot more. And that's one of the frustration is, over time that, you could have, we could have grown so much more if you looked at both sides of the coin, right? Because
Yeah.
let's say you were a W-2 guy making, 200 grand a year, um, and you were paying maybe 50 grand in taxes. Well, you could just, without your W-2, still manage to get like maybe 120 grand, of income, and
Hmm.
150 grand. And at the same time, if you think properly about your tax optimization using passive investment and depreciation and all these good things, um, then you would pay zero taxes. So at the end of the day, you will be at the same place, right?
Yep.
Except that now
Yep.
you're more free. You have a better setup, financial setup for yourself in thinking about building that growth. But for someone who wants to leave the W-2, there's a lot of other things you need to think about. As I said, have a line of credit in case for rainy days or to tap
Yep.
into it where there's opportunities that come. Think about like healthcare and how you can replace that from um, either through Obamacare or through some of those health ministries,
Sure.
side. Um, this, you know, as I said, set up your structure properly. Maybe set up a side gig as you're working until it start really maybe starting to cash flow before you leave. So there are a couple of steps to take that will make you a lot
Okay.
more comfortable than just calling it
Yep.
not
And,
being.
and all of these things are like very close and personal to you right now because you just recently left your W-2, I believe, correct?
I did, yes. And yeah,
Congratulations.
thank you. I had to go through through both the emotions and uh, the legacy of doing the same job for so many years,
Sure.
and then yeah, just prepare because cash flow doesn't come easy. You gotta build it.
Sure. Yeah, absolutely. And as somebody myself, as I mentioned, I was primarily investing in wealth opportunities, wealth accumulation opportunities, value add multifamily primarily. And I shifted over to where I needed the cash flow. It takes time to shift your portfolio to bring on cash flowing investments versus, um, it doesn't just happen automatically. So that was a little abrupt for me because I got laid off. But I think with a little bit of planning, you can transition dollars because these are illiquid. You can transition dollars to set yourself up for a smoother transition than maybe some folks have experienced. So, well, let's if we can, I'd love to hear your thoughts. The market has been challenging for multifamily, interest rates going up. The Fed has been very, very interesting over the last 18 months or so. I'm curious, where do you see the market today and where do you see it heading in the alternative investment space?
Yeah, it's definitely more challenging for housing. It's been a very interesting and counterintuitive market, right? Because you would have told me the Fed had increased rates by 550 basis point or more, and uh, would be 10-year would be at 5%, and uh, I would most likely thought that the stock market and the real estate would be actually a little lower than it is today, but
Mm-hmm.
there are a lot of other factors that are out there.
Yeah.
Inflation was a big, driver of why the Fed acted, and rightly so, because once the inflation genie's out of the bottle, it's very tough to maneuver. And
Sure.
you can ask Argentina for that. Um,
Yeah.
but slowly has stabilized. But we also, if you look back in the 70s or in the 40s when we had those episodes of inflation, they come in cycles. Uh, so I don't think we've seen the end of it for this cycle. They usually tend to be about 7 to 10 year cycles as well, with like big highs and you know big lows, and then back to big highs. We're probably at
Okay.
the we're probably at the bottom of the first phase. Um,
Okay.
I think rates. A lot of people were last year, especially, and earlier this year, was that at some point the Fed is going to cut rates again, and rates are going to go back down, and everything is going to be fine. Um, I think the market is finally realizing that you know we're in a different cyclical environment from a lot of different factors that are out there, and obviously inflation being one of them. The
Yeah.
resiliency of the economy has been spectacular, but that's because there was a lot of freebies out there during
Yeah.
COVID. Then the government is still spending. I mean, they spent $2 trillion still this year without
Right.
any recession or anything on their infrastructure bills and this and that. So the government keeps pumping money into the system and projects that are keeping the economy out there. Workers, still a lot of workers needed, and wages keep going up. So I think medium term we're in a different environment where before maybe the 10-year note was between 0 and 3%. We're probably now between 3 and 6% for a while.
Okay.
For 20 years we had rates just steadily going down from the 1980s till now. I think now we're on the opposite, where we're probably heading higher and higher. But what
Okay.
happened during those 30 years is that you had nasty sales off every time, but like back to the trend lower. So I think this case the trend is going higher, but with nasty rallies every now and then. So
Okay.
you may have opportunities to refi if that's something that people think about, especially in passive investing and multifamily and whatnot. But
Okay.
so I don't think we're returning to the days of earlier last decade.
Yeah, yeah. No, I think the days of 3% mortgages, 2% mortgages, I think those are long gone for sure.
Yeah.
Now that's created an interesting environment for operators that were leveraging floating rate debt. And what are your thoughts about the next 12 to 18 months with a lot of those deals? What will that create opportunity? Will there be blood in the streets as we've heard so many people talk about? What are your thoughts there?
Yeah, I think there's definitely the people who got hurt the most is people who are exposed to floating debt. So
Yeah.
any development project that started before and now has to find the final debt that they need to for their building, or multifamily who are leveraging and buying 3.5 caps and using floating rates.
Yeah.
All these projects are bleeding. All these projects are calling for either new money or new capital or new loans.
Yeah.
So that's definitely hurting. Now, there's a whole other area in either corporate bonds for companies that are also tend to have more fixed debt than not, but they're slowly going to start rolling into maturity, and so we'll need to refi, and the rates is definitely a lot higher than they had it for the last few years, and
Hmm.
that's just going to impact their profitability, and so and there's always events that you don't see, that you don't foresee, that are created by
Yep.
rates going high, too high and too fast, and we've gone both too high and very fast. uh,
Interesting. Yeah.
so you know, there's always that risk out there. There's, some private equity fund, you're seeing it as well, who are very leveraged. And sometimes those funds, the PE funds, anybody who has a maturity deadline and who has floating debt, those are the people who are getting hurt the most. And so in private equity, we haven't seen it yet. We're starting to see it a little bit in the secondary market. There's what they call secondary private equity. Because if you buy a private equity fund, usually you sign up for, as I said, a 7-year lockup. And so when that
Okay.
7 year comes, they need to give you back your money. So they need to create liquidity. They need to sell assets or something. So they
Yep.
sell it usually to secondary private equity funds at a discount. Usually that discount is pretty low, between 5 and 10%.
Okay.
And today that discount is at 20%. So it's not a bad time to be in
Wow.
secondary private equity, but the primary equity private equity funds can find some, they might start feeling some pain and some challenges as well, right? Uh,
Interesting. Now,
and
does that flow all the way up, would you say, to the S&P with some of the larger Fortune 100, Fortune 200 companies that were maybe pulling debt or taking advantage of debt back in 2020, 2021 as well? Or
I mean, technically, yes. The profitability just mathematically has to come down, right? Like your inflation is higher, meaning that your wages are higher. I
yep,
think 14% in the last 3 years. So your cost of
sure.
people is higher. Your cost of money is higher. The financing
Yeah,
we just discussed. The cost of goods is higher because inflation, wreak havoc into those as well.
yeah,
Because you didn't find the commodities that you needed. So, that's a lot of cost, all these costs that add up and technically should reduce your profitability. So what we've seen is that those companies like kept raising their prices and people kept paying it. So they were fine. They were just basically pushing that increase in cost to the consumer. But I
hmm
think slowly seeing the consumer, is slowly going to get hurt. And then at the end of the day, the American economy is 70% the growth of the consumer, and so
Yep.
if the consumer gets hurt, then the economy gets hurt, then the S&P gets hurt, and so it should
Yep.
slow down a little bit. We're gonna might see unemployment slowly leveling back up a little bit. You might see, uh, starting to see it. I was just looking at credit card defaults and even used car people like just default on used on financing for their cars
Yep.
uh, is back up to like 7.5%, which is like I think the highest since 1994. So you're slowly starting these costs like starting to affect
Yep.
the economy and consumer in general. So
Yeah, it's interesting. I heard a statistic last week or the week before where they showed that credit card balances have increased significantly, but credit card defaults had not increased. So there seems to be a lag, which would make sense that at some point it's got to break if balances keep growing and growing and growing. But a portion of that could also be people just leveraging credit cards how they're supposed to be leveraged, charging them up and paying them down. But it'll be interesting to see, I think, in the next 90 days or so, whether those high balances start to lead to more defaults as well. And that could have been a lagging metric that I saw, but yeah, it was an interesting thought to see that they hadn't really connected at that point yet. So
yeah.
I'm curious your thoughts. Nobody's got a crystal ball, but what do you see the Fed doing? Uh, over the next handful of months, do we see another increase? Do we see it start to level off? What are your thoughts there?
Yeah, I mean, I don't think the numbers we had were weak enough to warrant the Fed that is just gonna start definitely cutting rates. So that's probably not in the cards yet, and the markets have
Hmm.
started. They were pricing a lot of cuts in 24. Up to 160 basis point at some point, 1.6%. That's not the case anymore. Um, because it's staying higher for longer. So I think they're gonna just cruise a little bit around here and see
Okay.
what happens and see really if we start seeing the economy turning the other way before they act. And they probably
Got
don't
it.
want to act too soon and overreact to things. But I think they've done enough damage. I mean, as I said, the financing is costing on different levels. I mean, you look at even small businesses, which are kind of the heart of America. It's if you have an SBA loan, it's a floating rate, and it went from 5%, a year and a half, 2 years ago, to close to 11% now, right? So,
Yeah.
um, I still like small businesses. Don't get me wrong. I think it's a great avenue actually for investment as well,
Yep.
because they are still cash flowing probably better than real estate, much better than real estate. So I like investing in small businesses, but it comes at higher cost for sure.
Okay. Awesome. Well, very good. This has been a very interesting conversation. I appreciate all of the insights you bring here, and obviously to the community that we're a part of as well. It's a different caliber of conversation than what I had been having for years. So, thank you for all that you're doing in venues like this, and also in the mastermind that we're a part of. I learned a tremendous amount from you. Uh, I'm wondering if we can, real quickly. I do have a handful of questions I'd like to ask everybody before we wrap things up. Um, so
Sure.
let's do that. I'm curious your thoughts, or do you have any advice for folks that are used to just investing in 401ks and the stock market? Are there any particular resources that you like to share with folk, whether it be books, podcasts, research resources that could help them start their journey towards alternative investing?
Sure. I don't know if I have anything in mind, but I can, some pointers. I think keep an open mind. Uh,
Okay.
get help as well. Like I mean, there are masterminds, there are coaches, there are all kinds of people who can help you. Uh, and and yeah, then you'll start understanding that even your 401k, you can move them into a self-directed IRA or a 401k solo, where instead of being like really stuck into investing in the five funds, mutual funds that they offer you, you could use
Yeah.
that money to actually grow it and put it in passive investing.
Yep.
And that could be anything. That could be a private equity fund. That could be a syndication that you bring. That could be other real estate syndications. It could be small businesses. There's a lot that you can do with your money besides like just having it in a traditional 401k. Um,
Okay.
and obviously think about these things like Roth IRAs instead of a traditional Roth, self-directed Roth, even better. Um,
Yep.
you know, the, there's a lot of resources out there. Just don't be shy about asking and keeping your mind open.
Got it. Perfect. All right. And kind of a fun one I've just started asking over the last few months. If you were to place 100 grand today in an alternative investment, where would you place it?
Well, I'm bringing a syndication actually that will. It's a holding company that invests in small businesses, and so as I said, small businesses, the cash on cash is so much higher than any other thing. This actually can give you both cash flow and appreciation because the businesses, the multiples and the valuation increase with time as the operator does a good job. So, I think these type of syndications are great. And then if not, I will always look at the tax advantages. So I like things in real estate that offer me good depreciation because as a rep status or whatnot, I can use some of those depreciation against some other income.
Sure.
Um, and so mobile homes or other assets that give you more depreciation than not are always favorite to mine.
Okay.
And and then as I said, I tend to look at a lot of other things. So I don't mind a little bit of tech, a little bit of small businesses, some commodities to hedge for
Sure.
inflation. I have a very diversified portfolio of it.
Awesome. Awesome. And then kind of a fun one here. Is there a recent bucket list item you've checked off of your list or one you're hoping to in the future?
Good question. So travel for me is what I like to do with the kids, and I haven't done as much since COVID. So I still have a bunch of bucket lists in there. One of them being a safari.
Oh,
Uh,
very good.
I need to start planning for that.
Yeah. Everybody I talk to that has done the African safari says it's their favorite vacation they've ever done. So my wife and I have that on our bucket list as well. Hopefully in the next couple of years. So
Yeah.
we're certainly fans of travel bucket list items for sure. So very good. All right. And then, of course, you did mention that you have a fund or you have a syndication that you're putting together. How could our audience connect with you to learn more about your offering and how you could help them with their passive investing journey?
Sure. Yeah, they can reach me at HHH, so triple H at wealthflowpartners with an S.com. I think that's the easiest way, and yeah, I'll be happy to help in any way I can.
Fantastic. Well, thank you again so much for coming on the show today. You've brought a ton of value to the audience. And I really respect what you do and all of the information that you bring to our community. So thank you so much for being here today and for everything that you do in that community as well.
Thanks, Randy, for having me. Appreciate it.
Awesome. All right. And to the audience, as always, thank you again for joining us today. And as always, I'd like to encourage you to continue your education journey with passive investing in alternative investments. More important than that, though, I encourage you to make a decision to make that first passive investment. I'm convinced that once you do, you wish you will have started this long ago. And this will help you take one step closer to decreasing your dependence on your W-2. So thanks again for joining us today, and be sure to join us next Thursday for another great episode.
Well, there you have it, ladies and gentlemen, another episode of The Gentle Art of Crushing It. It was an amazing episode. We know we sure learned a lot, and we hope you did as well. We want to take a second and thank you so much for viewing or listening to this episode. And please just know that we only ask for one favor, and that is to make this life magnificent. Thank you, and have a wonderful day.